Hey everyone, it's Dave Barnett again. Today I received an email from someone who's just newly arrived in this country who was in my Business Buyer Secrets seminar on Wednesday, just 2 days ago. And the Business Buyer Secrets seminar is something that I've offered sometimes as often as 5 or 6 times a year for the past 3 years or so. And a couple of times I've offered it in conjunction with some not-for-profit organizations that help settle new immigrants. And in yesterday's group, or Wednesday's group, I had 16 people who are all here under an immigrant investor program, meaning that they get fast-tracked to Canadian citizenship if they start or purchase a business within 2 years of arriving, and they have to invest a certain minimum amount of money. And one of the questions that came up, which for years I've always heard from new immigrants, is how do we ensure that people aren't lying or defrauding us or taking advantage of us by giving misleading information? How do we know that people aren't creating false financial statements, for example, or telling us lies about, in business, some small businesses will choose to not declare some of the sales because they want to reduce their tax burden, and then they'll tell a potential buyer about this and hope that the buyer will value those sales in consideration when they're buying the business. So the question came up: how do we know if people are lying to us? And the answer to that question, firstly, it's not a question solely reserved for new immigrants. Anyone who's in a big transaction like buying a business has these concerns. Are we being told the truth? So the way that we do it when we're entering a transaction like buying a business is we have to create a set of circumstances where the seller has a vested interest in our success. And if they're lying about things like the sales and we are not successful, we want to make sure that they are going to share that pain, and we want them to realize that before the transaction is completed. And the way that we do that is with debt. So typically when you buy a business, you rely on a bunch of information provided by the seller. And some of it is verifiable and some of it is kind of hard to verify. You do the best you can, you verify what is available. But at the end of the day, there are certain things that you're sort of taking on faith or trust that you've been told are true. So if you were going to buy a business, for example, for $500,000, what you would do is you would put in some of your own money as a down payment. And maybe there are assets in the business that you can finance from the bank. So you get some bank loans, maybe for equipment, machinery, a line of credit perhaps for inventory, and maybe financing some of the receivables. And then you always leave something on the table to be paid later. Essentially what you do is you ask the seller to finance part of that transaction. So you're going to buy a business for $500,000, maybe you put $100,000 of your own money, you borrow $250 at the bank, now you're up to $350, and you ask the seller to finance the last $150. So you're going to buy the business for $500, he gets $350 on closing day, and on that day you're going to sign a note saying that you're going to pay him the balance under whatever terms you negotiate. Let's say you're going to give him 5% interest, and you're going to pay it over, 5 years, monthly payments. But in that note, in that loan agreement, what you're going to do is you're going to have a clause that says this note, subject to offset, in the case of undisclosed or undiscovered liens or material misrepresentations. What does that mean? Well, let's imagine, for example, that you buy a business, and on the list of assets included in the sale is a forklift. You get the keys to the business, you pay for the business, you get the keys. 3 months later, the sheriff shows up looking to repossess the forklift. And he's got documents from a leasing company showing that they actually own it and they haven't been paid in 3 months. They want their forklift. Well, that offset clause on the note gives you the ability to pay the sheriff the amount of money that's due and deduct that sum from what you owe the seller. So it's a way for you to control the hazards associated with the seller misinforming or misrepresenting to you. A material misrepresentation is a legal term, which means there was something really bad that they omitted to tell you or outright lied about. Fraud. So, they gave you a customer list and they knew that one of their biggest customers was in the process of going bankrupt and they didn't tell you. In my mind, that's a material misrepresentation. It's an important piece of information. So, if, for example, you bought a business and you paid all cash, you handed them $500,000 on closing day, and then later the sheriff came for the forklift, you'd have to pay the sheriff, then you'd have to hire a lawyer, find the seller, sue him, prove in court that he misrepresented about the title of the forklift, hope that he hadn't spent the money, and then once you got your judgment, you would have to try to collect. Big process. With a properly structured vendor take-back note, you just deduct that amount from the note, and if he disagrees with you, he has to hire a lawyer. He has to sue you, and he has to go to court and prove that he did act honestly and tell you everything that he was supposed to tell you. So what it does is it quite literally moves transaction risk from the buyer to the seller. In the sale of something like a business, or any large complex asset for that matter, you have to remember that the seller typically has a whole array of assets. They'll have a house, the business, cars, vacation homes, retirement accounts, many assets. The business is one of them. Could be a big one, but it's one of many assets. The buyer typically is a person who wants to make an investment in a business, but also is buying a job. They're looking for a source of income. And typically they're going to take all of their savings, maybe borrow from family and friends to complete the down payment. They're going to borrow from banks, maybe take money out of their retirement account, maybe put another mortgage on their house, and borrow from the seller. They're basically going to put all of their assets down into this one transaction. In my experience, most buyers of businesses, first time especially, that's the situation they're in. So the buyer has a tremendous amount of risk, the seller has very little. So the vendor take-back note, properly structured, moves risk from the seller to the buyer. Why then would sellers agree to this? And the answer, quite frankly, is twofold. Number one, a seller who is willing to do a vendor take-back note is demonstrating to buyers that he's being forthright and honest and has nothing to hide, number one. He's also demonstrating that he believes that the buyer at hand has a capacity to run the business, so it's a vote of confidence at a time when someone probably needs one. It's also important for a bank to see. If you're buying a business and you go to the bank to borrow money and the banker can see that the vendor, the guy who knows the business better than anyone, is also willing to lend some money, that gives the banker a higher degree of confidence. But for the seller, the biggest reason is that by being willing to do a vendor take-back note, ultimately, he's going to provide the financing to buy his business that buyers can't obtain from anywhere else. And the price of assets is determined by the availability of financing. If you can't get a mortgage, what are houses going to sell for? If you can't get a car loan or a lease, do you think you would see many $40,000 cars on the road? No. People need financing to buy stuff. So ultimately, for the seller, by being willing to do a vendor take-back note, they're going to sell their business for far more money than the seller who is not willing. And in fact, in my experience, I spent 3 years as a business broker, did 35 deals here in the region. Sellers who were unwilling to do a vendor take-back, their businesses were on the market far longer, like years longer, and ended up selling for far less. Because the only people that could buy their business were people with a lot of cash, and people with a lot of cash know that they have a lot of negotiating power. Anyway, just some thoughts from the seminar on Wednesday. Take the time to visit my blog, www.investlocalbook.com. If you want to learn more about local investing, visit the blog. You can download 15 of my business finance articles for free. And don't forget to buy my book, Invest Local. It's available on Amazon in softcover and for Kindle. And if you go to investlocalbook.com, you can also buy it as a PDF download. Thanks a lot, and we'll see you later.